All right, well, hello and a very warm welcome to everybody who's joining us today for this Barchart webinar. My name is Jean Baker, and I am going to be your moderator for today's session, which I'm sure is of great interest to anyone with a stake in today's market. We are going to be talking about covered calls and how to use them for income generation. And the webinar today is again going to be run by Barchart's John Rowland. Hi, John, are you there?
Hey, Gene, how's it going?
I'm great. How about you?
I'm excited to be here today again.
Well, great. Yeah, welcome back to John. And if you've been in one of our previous sessions as of lately, you notice that John is a very experienced trader. He's bringing many, many years of knowledge about the markets to our Barchart audience. We're really happy to have him on board. And while he's been our keynote presenter in the latest series of webinars, you'll notice that he's also going to be able to bring this unique trader's perspective to how to best use the tools that you have on the Barchart website. And you'll be able to use these tools to your best advantage. So I also do need to remind you before we get started here that any information that you get from today's webinar is really for informational purposes only, information and education. This is not a recommendation to buy, sell, hold, or trade any securities or any other investment. Your decision whether or not to make a purchase should be based on your own due diligence and not on any representation we make to you. With that, I'm going to turn the presentation over to John, and he's going to start telling us all about covered calls and how to use this to our best advantage. Go ahead, John.
Yeah, so as Gene says, we're going to talk about covered calls. So here we are in our main page. Now, before we start with the covered calls, I do want to talk about some ground rules and some assumptions that I'm going to do today. So the first is the assumptions that because you're in this options seminar, I want to let you guys know that I'm assuming that you have a basic knowledge of options, what a put and a call is, what the underlying asset is, what is the expiration date or what a strike is, and also what are the influences of factors that price out our options, price of the underlying, the strike price, time to expiration, volatility, and concepts like at the money, in the money, and out of the money. We'll look also at how dividends could affect our profit or loss in terms of when we do our math of the covered call strategy. The other thing I want you to understand is that the primary goal of a covered call strategy is increased income through ownership. And so when we look at our covered call screener, I want you to understand that the execution of a covered call strategy is simultaneously purchasing the underlying asset, the stock, and at the same time selling a call option. That is how the page is designed, the covered call page is designed. And that the strategy itself is best designed for those markets or those stocks that are in a slightly bullish trend, or maybe in a sideways or neutral trend, sometimes referred to as range bound. And they're not really great design for parabolic markets that have been increasing at a very high rate. Covered call strategies do offer us some limited downside protection, and we're going to look at that balance between upside profit and income and that downside protection. But if you believe that your stock is going to go down in price, then covered calls is not the ideal strategy for you. You would probably want to use some kind of a put strategy. Okay. The other thing I just want to mention to you guys is when we go through the math of all this stuff here, I have a calculator that I'm going to use. Now, I don't know, we've had some technical difficulties setting up. I don't know if you can see my calculator. Gene, can we see my calculator
Nope,
or not?
we can see
Okay.
your calculator.
Oh, we can. Excellent. Sweet. All right. That's a great thing to know. So when we do the math, you can follow along with me. All right. So here we are in our cover call screener. Now, just again, some basics here. Notice that the cover call strategy page is sorted by potential return. We'll look at that in a moment. And the other thing I want you to realize is that the information that we're going to look at is on a delayed basis, about 15 minutes, right? And it is throughout it's updated throughout the day, but it will be a little bit behind. That could change some of the math as we walk through one of the scenarios. Okay, so first of all, we have our symbol, right? And our symbols here, if I have a symbol that I don't recognize, I can just come in here and open that up. And this will give me a kind of a quick snapshot of whatever the symbol is. In this case, it tells me what the stock is. And what's important about this is when we go a little bit deeper into it is, one of the things that we're going to look at is something called the performance report as we decide what is the right strike price for us. So that's a way we can find that, all right? So our symbol, our price, that's the last price that the underlying the stock traded, right? And then our strike, what is the strike price of the call? Moneyness. Now, moneyness here, it says, is the relative position of the last price, the underlying price, to the strike. And so what this is really kind of telling us is how far is our strike price from our current price. So you can see here on this example here, our price is $9.16, and our strike is $10, and it's telling us that the difference between these in terms of a percentage is about 9%. Again, we're going to look at moneyness as a way to help us find better strikes, and we'll go into that in a little bit more detail. Now, don't get hung up on the fact that it's a negative number. Just remember that the value is based on the strike price to the actual underlying price. So the strike price, if it's above our current price, then that will be represented in a negative number, right? And so if we were looking at put strategies, it'd be in reverse. Just look at the raw number, and it's just telling me that in order for my price to get to $10, it has to appreciate by 9.7%. Our expiration dates, what day does that option expire? And that is going to be very important to us when we start to do that math calculation. The bid, right? What is the value of somebody who's willing to buy this particular call? Notice that we don't have the ask, because we're not going to sell at the ask. We're probably going to sell at the bid, but we will look at ways to maybe find a better price. Net indebtedness or net debt, right? And you can see here net debt is the cost to enter the trade. Remember, this call screener is assuming that we don't own the stock and we're going to purchase the stock and sell the call at the same time. And so that is the stock price, the price that I'm going to pay, minus the premium that I'm going to collect. And this is an important number. This is going to be a value that we're going to do all of our calculations from, but it's also a number that I'm going to start using in my technical analysis. And notice that it says that it is also referred to as the break-even point, right? So this is going to be important too for us. We're going to look at that value as it is in break-even and maybe put that value on top of our stock. Now, it does say here that if the stock price is higher than the call's net debit on expiration, then this call strategy will make a profit. And that is an important concept to remember, that as long as our stock stays above our net debit, we're going to make a profit. All right, break-even percentage. So what is that? Well, that's the difference between our last price and our break-even, right? And what this is representing to us is what is our downside protection? How much can price fall before we get to that break even. And now in this example here, on this first one, we would take in $2.85 and we would gain a 45% downside protection. That's a huge downside protection. So we're going to look at this relationship of downside protection as it also relates to our upside potential. And what we'll discover is that there is an inverse relationship. The more downside protection that I get, probably the less upside potential profit that I'm going to achieve. And if I am willing to take less downside protection, then I'm probably going to get a greater return. So break even is really just our downside protection. Volume and open interest are self-explanatory. Then we have our delta and our IV. Our delta is how much does the value of the option change as the underlying stock goes up or down. And that relationship is for every dollar that changes in the stock, our call in this case would change by 63%. Now, some of you who have other trading platforms, or you're executing options on other platforms, like Thinkorswim or TradeStation or TD Ameritrade, your delta on your option chain might be expressed in a decimal. So don't get confused here that 63% is a 0.63 decimal. So that would be something that you'd be aware of. Our IV is our implied volatility. And again, when we think about implied volatilities, when we talk about options, the greater the implied volatility usually will mean that we're going to get a higher premium price. And that's a good thing. But too much volatility, it can be a bad thing, especially in this scenario. So you can see here that, for instance, this first example, we have an implied volatility of almost 220%. That is almost too much volatility for what we want to find. Remember, we're looking for a stock that is moving in a very consistent and stair-like uptrend, and not one that has been parabolic. When I see a 200% volatility, I know that this stock has had a big price movement in a short period of time. So this might not be an ideal candidate for us. My delta, right? Again, from my own personal experience, I find that when I start looking at the math that plays out in these scenarios, that my delta is going to be somewhere between 25 and 45, and that relationship from delta to implied volatility, I kind of like to find that 2 to 1, where I'm getting twice as much vol as I am to my delta. So if I'm looking for a delta between 25 and 45, and I want to find the right vol, then I'm looking somewhere between 50 and 100. And that's kind of just a guideline. Your strategy could be different. And this is just an opinion that I have, that I've noticed. Potential return. So what happens here is we look at potential return, and now notice it says we have to go to our help page. And let's see if I can scroll this down. Yep. Nope, that's not that one. There we go. And here we see potential return. The potential return for this strategy is assuming that the options are assigned or called away from us. In other words, our price has come to our strike, probably above our strike, and that for calculating potential return, we're going to take the time premium, the income that we're going to take in, and we're going to divide it by the net debit. You can see that down here. So what is our time premium? Our time premium is our strike price plus how much premium that we took in minus the value or the price that I bought that stock in my entry price. Now notice it does say last price. So it is calculating based on last price. An annual return, well, this would be as if I annualize that potential return over a 365-day period. Now, this can be a little bit deceiving. I want you to be aware of that. You know, there's no guarantee that when I do one of these strategies, let's say I do a 30-day strategy, that I'm going to continue to get that return over the next 30-day period. So the annual return will be better for comparative analysis when we're looking at different strike prices. But let's go back to this potential return. So let's think about this. In order to maximize our profit, to get our potential return, the stock needs to be called away from us. It needs to come to that exercise price, that strike price. And if all things go as planned, as I plan out this trade, then the best scenario is that I'm going to purchase this stock, I'm going to take in premium, and eventually that stock will be called away from me. That's a good thing, right? We don't want to worry about the fact that the stock will be called away from us, because that's going to give us our greatest potential return. So the best laid plans is that I will not end up owning the stock at the end of this scenario. So I have a friend of mine who is his name is Greg Hadley. He's a former S&P market maker, and he calls this the blue sky scenario. And I love that term because it's really telling us the best laid plans, the best result that we can get. This blue sky event is that price moves up, accelerates, appreciates, excuse me, and we get exercised, that stock gets exercised away from us. That's our blue sky event. Now, we know in markets, and certainly in my experience, that markets never do what we tell them to do. And usually I get in trouble. My personal experience is I get in trouble when I tell the market what to do. But I want you to understand that the maximum profit is that blue sky event. So the next thing we want to start thinking about is what would be the proper strike and the expiration that I want to start to look for. So what I've done here is I've changed my screener here into alphabetical order because I've kind of done this homework for you guys this morning. And I do have this symbol here, AAL, which stands for American Airlines, right? And, you know, remember we said we kind of want to look for a market that's kind of steadily going up, and you can see that, you know, my chart here, you know, we've been around $11, you know, back in the beginning of the month, and we're now around $12, and you know, this has kind of been steadily moving up, right? Nothing parabolic about this. And so what I'm going to do is I'm going to look at, you know, what different strikes and what different expirations are going to give me those greater potential rewards, right? And so we do have some different expirations, and we do have a variety of strikes. So let's go to American Airlines itself. And I'm going to go to the options price grid here at the moment, just to give you guys a little bit of background information and help you to discern that. So if I go into the options price grid, I can look at all the different expirations that are available to me. And notice that we do have ones that are M's, those are monthlies, and we do have weeklies. And so, you know, some of us might have learned that, you know, I want to find a strike expiration where I don't have a lot of time, right? Because we know that as we get closer to expiration, that call will deteriorate or decay, and we're going to capture that premium. And yes, that is certainly part of the strategy. But, you know, remember, we own this stock, and we want to let time be our friend as well. We want to let price appreciate because we do own this thing, and we do want the market to get to that strike. So we're going to look for expirations of longer periods of times. Now, remember, who's going to buy our calls from us, right? Somebody has to buy that call. So we want them to believe that they're going to get that opportunity to see that call be profitable, right? And so those folks are going to want more time. So we're going to look for expirations of greater time. So one of the things that I would say to you is, let's start looking at expirations of 30 days or greater. And when we start to do some analysis between weeklies and monthlies, what we're going to discover is that monthly options will give us some greater advantages, especially when we look at ones that are relative in expiration time. So let's look at that. So here we see a weekly, which is in November 11th, right? And American Airlines is trading around $12.87. And let's just use, for an example, let's use a $15 strike. And here we can see that our bid here is 40 cents and our ask is 43 cents. Now that's only 3 cents difference, but you will notice that sometimes in these weeklies, that'll be a lot greater. You might see as much as 10, 15, or even 50 cents between our bid and the ask. But, over here, we do see volume and open interest, and we see, only about 300 lots have traded so far today, and our open interest on this one is only 900 or so. But if I look at the monthly, which is 1 week out from that, and I look at my 15 strike, now notice that our bid ask is 1 or 2 ticks. Now this one is a very tight market, but again, you're going to notice this. You're going to find that our monthlies will give us a much tighter spread between the bid and ask. And look at our volume here on our $15 strikes. We see a lot more volume and a lot more open interest. And that's because that phenomena is because our large institutional players are going to trade these monthly options, and they're going to kind of avoid the weekly options. They want that extra time because this is part of their doing their business, right? They're going to pay those premiums that we want to sell, right? Now, the other thing that we'll discover is when we start looking at monthly expirations, if you can find a monthly expiration that falls in what is called the March quarterly cycle, March, June's, September's, and December's, you will find a lot more volume and open interest, and you will find those institutional players are in those expiration months. So keep that in mind when you start looking for how far out you want to go. If you can find one that falls on monthly, that falls on one of these March quarterlies, then you're going to find some greater trading opportunities. All right, so let me go to the cover calls of American Airlines. And we just decided that we're going to look for a strike and, expiration of a monthly, right? And so I picked this one that is 30 days out, right, just to do this analysis. And here you can see my current price is still around $12.88. And I do have, a $14 strike, $15 strike, and $16 strike, right? And I'm going to look and see which one of these strikes is going to give me the greater potential for profit. And you can see the 14 gives me a potential of 15.6%, the 15, 21.4%, and the 16, 27.9. And remember, that's our blue sky event. We need American Airlines to go to $16 for us to make 27.9%, right? And if we look at our moneyness, right, it's going to tell us how far away current price is from this strike. And so you can see that the 14 strike is only about 8.5% away, where the 16 strike is 24% away. This is where we're going to go into that performance, right? And how I'm going to pick my strike is going to be based on the performance of my stock. Now, because I'm 30 days out, I want to look at what this stock has done for the last month. Now, there's no guarantee that American Airlines is going to go up 8% again next month, but I'm kind of using this as a guide for me. And I can see that over the last 3 months, that American Airlines has appreciated by about 33%, or about 10% a month. So, that 8 to 10% is a target that is very probable in terms of American Airlines. So I go back to my expiration, and I can see that the 14 strike is only 8% away. So that would be more probable. I know some of you might say, well, yeah, of course that's probable, John, because it's closer to current price. That one would get hit first. But when I do my strike selection, I'm just going to look at that value. If 8% of price appreciation gave me $20, then I would use that $20 strike. But in this case, it's $14, all right? So the next thing I'm going to do is I'm going to look at my price of my stock and my net debitness, in this case, $12.11, and my strike. And I'm going to look at my chart. And this is where I'm going to start using my visual eye, to find what might be even more of a probable event. Maybe I might be able to get lucky in terms of finding a strike that will give me a little bit more reward. So I can come into my toolbox here and horizontal line, and I'm just going to put in that $14 strike. I'm just going to draw that line. Now, don't get hung up on the fact that it's not right on top of the number. All you need to is right click on your line, and you can change your price, and you can apply it. All right, and so that's the $14 strike. Let's look at the 15. Let's put the 15 up there. All right, so here's 15-ish. Okay. And just for comparison, we'll look at the 16 as well. All right. Okay. All right. And then here I have a line that I've already drawn, right? And we said that, remember, we wanted to know what our net debit was, and our net debit in this scenario was around $12 and I think it was 11 cents. So again, I could just come in here and change this to $12.11 and apply. And now what I'm going to do is I'm going to look at this stock in terms of its price action in a technical sense, right? And if I'm getting price protection down here to around $12.11, I like that, because this is, where price has broken out and moved away. I might even give myself room, net debitness to somewhere around $12.43, where my most recent pivot low is, right? And if I look at my targets, $14, $15, and $16, right? $16. Which one could that be more likely to happen? And in this case here, $14 definitely looks like it's a very achievable. My $15 is my most recent pivot high, so that could be a good target for you to as well. The 16 is a little bit farther away. There's probably a little bit less probability that we're going to go to that value. So I like the 14 and the 15. Now, remember that we're talking about a blue sky event, right? We're talking about the best laid plans of our $14 or $15 strike. But what happens if American Airlines doesn't get there, right? What happens if it just languishes here for a while, right? Well, then I want to start thinking about something called the unchanged scenario. And what we're going to do on that one is we're going to look at how much income I'm going to take in versus my net debt. And that's going to tell me, as long as we stay above that current low price, in this case, the $14 strike was $12.11, and the $15 strike was $12.36. As long as price stays above that, I'm going to make a profit. I'm not going to make that potential profit, but I'm going to make a profit where my stock has stayed unchanged. So the way we do that calculation, the true math of it, the unchanged scenario is our net credits divided by our net debits, right? We know what our net debit is what is our net credits? Well, our net credits would be the premium that we're going to take in. But remember, we're talking about we're going to start looking for greater expiration dates, right? And so if I own a stock for, let's say, 30, 60, 90 days, then that also could mean that I could be taking in a dividend between that time. So my net credits will actually go up because I'm going to take in the premium, and I'm also going to capture the dividend because I own the stock. And that would be a way I could do that math. Now, that's going to give me a decimal, and I'll just times that by 100. That will give me a percentage return. What we're trying to achieve on a unchanged scenario is we want to find on a monthly basis, a 30-day basis, somewhere between 1 and 2% return on our monies. So if we look at the $14 strike and I take in 79 cents, where's my calculator, right? And my net debit is $12.11. Well, I'm just going to divide that 79 cents divided by $12.11, right? And times that by 100. And you can see that as long as American Airlines stays above $12.11 between now and September 18th, I'm going to get a return of about 6.5%. And that's a good thing. That's what we want. We want to make sure we get at least greater than 1 to 2% on a 30-day basis. So that would be a better strike for me. Now, if I did the $15 strike, I'm going to take in 54 cents. Now, 54 cents versus a $12 net debit, you can see that that's going to be about less than 5%, right? So maybe not as much return on that, but still greater than 1 to 2%. So either one of these would work for me in terms of that math, all right? So how do we determine which one is more relevant to me? Well, again, we could go to our probability of how much does this stock need to appreciate during that 30 days. And in this case, the more likely probability would be the $14 strike. And if long as price does not get above $14 and doesn't go below $12.11, I'm going to make about 6.5% return on my money. If price goes up to $14 and gets above $14, then you can see that I'm going to make a return of 15%. So a win-win scenario, all right? So this screener helps us find trading opportunities where we're going to purchase a stock. But let's say we already own a stock, or we have a stock that we've had in our portfolio. I mean, we don't have enough extra capital to invest in some stocks. So one of my subscribers had mentioned this to me, and I thought this was a great example for us to look at. So here's Ford Motor Company, and this subscriber actually said that they had bought Ford Motor Company because they liked the juicy dividend, and what happened was that Ford discontinued the dividend, right? And so they're like, well, what should I do? Should I get rid of the stock, or is there a way I can create some income off of this stock that is not performing anymore? So remember, we said we like to find our greater expirations in terms of time, and we like to find those March quarterlies. And so here I've gone to the December, right? I have 121 days, December expiration, and my current price for Ford Motor is $6.95. And here are some of the different strikes that are available to me. So I do have a $7 strikes. Now that's only 1% away. That's a very highly probability. I have an $8 strike, which is 15% away, and I have a $9 strike, which is almost 30% away. Again, I might take that time to look at my stock in terms of the picture that it's showing me. And, you know, this is a nice candidate, right? We have a nice trending market, right? It's not really parabolic yet. Excuse me, I'm going to go to this one. Right, here's kind of the beginning of our most recent trend, right? Nice little trending markets, right? And, you know, if I look at structure based on where I feel comfortable owning this stock, right? That might be around here, right? In this, right where this gap is, or even where these two lows are. So that's about 650 to about 635. And one of the other ones that I like to look at is, you know, I love the 20-day moving average, right? And so here we see that our stock price is above our trend line. Our structure is around $6.36, and our 20-day moving average is right around where we're at. And as long as my market stays in that range, then I feel confident that it's going to continue to go higher. Where is my most recent resistance? Well, my most recent resistance here is this previous high right here at around $7.40. But even all the way back here, you know, we could say $7.74. So let's go back to our cover calls. All right. All right, so we know that we want to have protection down around below 650, and we have a target of most recent highs between around 750 and 775. Now I could use the $8 strike. That would work for me, but I would need a 15% increase in price to get a 20% return. That might not be a real reality for a Ford Motor, right? Because it's kind of been stuck in this very slow, steady price climb, and it might be in a range-bound activity. So if I have a stock that I like, I own, and I don't have an emotional to it, I won't be afraid to look at the strike that could be at the money, right? And you can see the $7 strike here is at the money, right? Our current price is, you know, around $6.95, give and take 5 cents. And if I take in 67 cents here, remember our unchanged scenario, I'm going to take in 67 cents, and I'm going to divide it by my net debit, $6.20, 26 cents. Look what happens. As long as Ford Motor stays above $6.26 between now and December, I'm going to get a 10% return on my money, even if it doesn't go above $8, right? $8, I'm going to get a 10% return. So what I've done now is I've turned a non-performing asset Ford Motors, and I'm creating a dividend income, so to speak, right? Now, remember, this is a 10% return on my money on 120 days, so we'd have to divide that by, what's that, four 30-day periods. But I'm getting a return of almost 2.6% per month. That would be better than any dividend, I think, that annualized that Ford Motors would present to us, right? So here I'm creating income from a stock that I already own. Now, could I do the $8 strike? Yeah, I could. And you know, my math is going to be a little bit different. I'm only going to take in 30 cents, so I'm probably not going to get that 10% return, but I think you could see here it's probably going to be around 5%, right? Maybe a little bit less. And so I'm only going to get maybe 1% per month for the next 120 days. So on this one, I could use either one. I could use the $7 strike or the $8 strike. And maybe I would use a blend, and maybe I use half of my portfolio at $7 and half of my portfolio at $8. But let's look at the $7, right? And this is why I don't want you to be afraid of looking at in-the-money strikes when you're doing this. You're trying to create income from a non-performing asset, right? Because we know this market might just kind of be in a range bound. If somebody buys the $7 call from me, they're going to pay 67 cents, right? So their break even actually is $7.67. They need the price of the stock to go to $7.67 in order for them to probably exercise that call away from us, right? That stock away from us. And that value is our most recent high. So this even works even better for us, right? Because in order for us to get exercise, this stock actually has to make a new high. And so what I might be able to do with this one is I could continue to sell these strikes as I go from month to month or 3 months out, or in this case, 4 months out. So here's how I can turn a non-performing asset that is kind of creeping along or maybe range bound, and to create a dividend based on a cover call strategy. All right. So let me show you another kind of cool little trick that we can use, or a hack that we can use using cover calls. So I'm going to go back into options here. And one of our popular tabs here, pages, is unusual options activity. And what this one does is it looks at volume versus open interest in all the different options that are out there. And it's going to identify when we have an increase of volume that's greater than the open interest. Now, what you can see here, it says that unusual options can provide an insight what the smart money is doing. And usually that is the case, that our large institutional players, or those that are in the know, you know, they're putting monies to work, and this will create the unusual activity. But you can see that we have a lot of options to look at, and you can see that down here we have 600 we have to pick from. So that might be too many for me to look at, right? So here's a little trick. I'm going to go in here where it says screen. Now we've learned the math of the cover call, and I'm going to take all these unusual options stocks that are trading, and I'm going to set some new filters. I'm going to use those parameters that we talked about. Now, I'll go over here, and one of the ones that we said that we like is our delta, right? Looking for that delta somewhere between, 25 to 50. So I could put in a range of 25 to 50-ish, okay? And then I would look at the results. So I could add option information, right? I could look at my days to expiration, right? I could look at my volatility. I want to make sure that my volatility is right. So what I've done is I've created a screener already, and here is called the unusual delta IV, volatility, and days to expiration. So you can see that I've done my delta between 25 and 50. I'm only looking at monthly expirations. I'm looking for days of expiration between 30 and 130 days, and my implied volatility is going to be between 50 and 100. And let's see what happens. And now we've taken those 600 different options and we've narrowed it down to just 16, right? And now I can kind of focus in on those things that are more important to me. Now, as I look down here, you know, if I see a symbol I'm not familiar with, you know, I can open up the plus and look at it. But what I see here is something that jumps out right at me, and I can see that on this particular option today has traded 11,000 contracts, and the previous open interest is only 1,600. Somebody is making a bet, right? My delta is less than my IV. That's what I like. I would like to see a greater ratio here, but that works for me, right? Before I move away, before I go any deeper in this, I might look at what is this symbol? Well, this is Freeport McMoRan. It's kind of caught up in that whole gold thing. And, you know, what has it done in the last month? Well, we were just trading $13 only a few weeks ago, and we're now around $15. So, you know, nice steady rise in price. And if I look at my performance, right, bar chart opinion is a buy signal, and my performance, you know, it's gone up 10% in the last month and about 60% over the last 3 months. Now, 60% is a lot, but, you know, the overall market has been up about 50%. So it's kept up with the overall market. So somewhere between 11 and 12%, 11 and 20% would be a range of probability moving forward. All right. So here is the current expiration that we see, where we see this large volume. That's the November 20 contract. So I'll go to, Freeport McMoRan. And we want to look at the 11/20, and there's that volume, that big spike in volume, right? Somebody's bought a lot of $14 calls, and somebody's bought a lot of $16 calls. So let's do the math on the $16 call. All right, my current price is $15. I'm getting 6% price protection to the downs. $16 is only 6% away from current price. I'm going to take in $1.20 in profit. My net debit is $13.87. My break even is downside protection is about 8.5 or 8.6%. That's a nice value. I like that. And my potential profit, my blue sky scenario, is 15%. So the numbers work for me, right? What is my unchanged scenario, right? So $1.20 divided by my net debit, $13.87. And again, I'm not taking into consideration of dividends. And so as long as Freeport McMoRan, it stays above $13.80 between now and November, I'm going to make 8.65% return on my money. If it goes above $16, then I'm going to make 15%. That's a nice return for 90 days of owning this stock. All right. So what I've done here is I've blended two of the tools that are in Barchart. I'm looking at unusual price action, options action, and I'm using that cover call strategy where I want to make sure that I get enough return on my money on a blue sky event, but also I want to make sure that I'm consistently bringing in monies based on an unchanged scenario. So here's a way that we can use those two tools together. So let's kind of sum up here. All right. What are our takeaways? Okay. Cover call strategy is best suited for those markets that are in a very steady or ladder-like uptrend or in a range-bound sideways action. We want to make sure that when we set about setting our strike prices, we want to make sure that the value of the strike is not too far away based on the performance of our stock. We want to make sure that we have enough time to let that stock price appreciate, not only for us, but also to lure that individual or trader who is going to be willing to pay those greater premiums. We're going to use net indebtedness to help us determine what is a greater profitability of it. And we're going to look at that in terms of a potential profit, but also in terms of what we call our break-even scenario. When we look at our break-even percentage, right, there's going to be a balance, a give and take. The more downside protection that I give myself, the less upside potential profit I'm going to get. The less downside protection that I'm going to get, the greater the upside profit. I want to make sure that my market has enough volume and open interest, right? I don't want to be just trading, be the only one of, maybe 20 contracts. That might be a strike that I want to stay away with. And then when I look at my delta and IVs, I want to make sure my delta, again, from my own personal experience, somewhere between 25 and 50. And you'll discover is that a lot of the ones that fall in that, like that 30, 35, those ones are the ones that give us the greater probability of our blue sky events, and that our IV is greater than our delta. Some of the markets you're going to look at, for instance, like a Microsoft or a Amazon, you're going to notice that your deltas and your IVs are pretty close together. It doesn't mean that you won't be able to find trading opportunities, but your rewards are going to be a lot less. I'm looking for those, those 7, 8, 10, 15% rewards. And then so if I can find a 2-to-1 ratio between my delta and my IV, then I know that that is going to give me a greater reward. And then our potential return. Remember, it's a good thing that we're going to get this stock called away from us, because that's going to give us our maximum profit. All right. So those are the basics of a cover call strategy. Those are the takeaways of the cover call strategy. And I hope that you guys will found some value in today's webinar, and go out there and try this out, and you'll be surprised how very easy it is for you to find some really nice trading opportunities. So, Gene, do we have any questions? I know I went a little bit over for our design time, but
no, we're right on time here. Thanks very much, John. There are a few questions that maybe we can squeeze in here. Aaron's asking, as far as a covered call strategy goes, should an option investor look for a lower price stock, like one under $25, with higher IV to give a higher probability of potential positive return?
That's a great question. I think I wouldn't be afraid to look at some higher price stocks. And it's all relative, right? It's, a higher price stock, you're going to get some greater premiums, where, here we were looking at a lot of examples where, we're getting 75 cents or 60 cents for our calls. You look at like a market like, Tesla or Apple, you're going to be getting, $10, $15 sometimes on some of these calls. So it's all about the math, right? So as you said, Aaron. So Aaron, yeah, I think, you think about how much we have to put up to buy that stock and then sell that call, I might have a limited amount of funds. And so, yeah, I would probably be, in my personal experience, I do like to find, those stocks that are probably somewhere between $20 and $60 because I know that I can afford those, right? Where if I'm trading like a Google, which is what, $3,000, that's a lot of money that I have to put out, capital that I have to put out in order to execute that call strategy.
Okay, great. A few other people have been asking if you have any advice as far as when to use a weekly expiration.
Yeah, again, I think, just make sure your math works out, right? And I would really hold out for, that unchanged scenario where you're getting, closer to above 2%, right? So, I want to make sure that, I'm getting a good return on my money. And I'd probably hold out for, like 5, 6, maybe even like 8%. Now that those trades aren't going to come around because remember, we're inside of a weekly, especially if we're looking at a weekly that's inside of 30 days, we're already starting to see that call starting to decay, and there might not be somebody who's willing to pay that premium. Now, if I'm looking at a weekly that is outside of 30 days, yeah, for sure, then that would work for me. But just remember that our institutions, those who are part of their daily business, are more willing to pay for an option that has a monthly expirations versus a weekly expiration. But yeah, if I find a weekly that is 60 days out, then yeah, that would work for me.
Okay, maybe we can squeeze one more in here. Johan is asking, if the underlying stock goes down and you've captured 70% of the premium collected, would you take the profit or would you just let it ride until expiration?
Wow, that's a tough one. So I think that scenario would be if you had a fear, or maybe you were looking at your chart and you are starting to see a downtrend develop, right? And you're getting close to your break even, right? So that profit would disappear if price fell below your net debt. That might be a scenario where I would take profit. But I think in terms of risk management, if I am in tune with my market, I might have a stop close to my break even for the stock itself, and I would let that probability run out, right? Especially if I do a good job in making sure that my net indebtedness is in an area of where I believe that there's support. So yeah, I think if I saw a beginning of a very strong downtrend or an acceleration of price, that might give me concern, and I might take that trade off because I want to get out of that stock. Now, remember, you might be selling the stock for a lower price, and that will eat into your profit. So you won't gain that greater potential profit or that profit of unchanged. You're going to eat into it. So there's a give and take there too. So be careful on that one.
Okay. Well, there are a few other questions, and I think maybe I'm going to take these and answer these for you, John. A lot of people are asking, is there a replay on this webinar? And the answer is yes. You are going to get an email a little bit later on today with a link to the recording. Otherwise, the tools menu, which you can see on John's screen up at the very top, has a webinar archive page. He's showing it to you right there, free webinars. And a little bit later on today, under the Premier Membership Tools in the left column, you'll see it says using covered calls for income generation. That's today's webinar. The recording will be available there a little bit later on this afternoon. The other question that I'm getting is people are asking, do I need a Premier membership to do all these things that John was showing us today? Some of the things that John went through are free for you to use. You don't have to be a Premier member, but if you want to take advantage of the option screeners, the covered calls screeners. You know, we're looking at the unusual options activity page and then screening on those options for possible candidates. You will need a Premier membership to do that. We offer a free 30-day trial, and it's very easy to sign up. You can check out all the different Premier membership features besides all of the option screeners that are available to our Premier members. So if you haven't tried Premier, I really suggest that you give it a try, see if you like it. And if you have tried Premier in the past and this webinar has really piqued your interest, then go ahead and contact us and try Premier again for another 30 days. John just also closed down a little webinar notification. I was going to have him talk about his webinar that he's going to be running next week, how to trade using multiple time frame charts. John, you want to give us a little preview?
Yeah, sure. One of the things I've noticed that when I tutored or have been in front of the classroom, I see a lot of traders will do a lot of their technical analysis on one time frame, and a lot of them will do their technical analysis in what I would call micro time frames, 5 minutes or 30-minute time frames. And what this webinar is going to do is going to teach you a skill where we're going to do what is called multiple time frame analysis, or top down. We're going to look at the big picture in terms of probability and price action and trends, and then we'll drill down to lower time frames to find more profitable entries or more realistic targets. But it's a technique that a lot of experienced traders will use to enhance their trading skills. So we're going to look at multiple time frames. We're going to get a greater amount of data, and that's going to give us a better picture of what we're trying to achieve.
So I hope everyone can join us next week, Wednesday, August 26th. John's got another exciting, informative session planned for all of you out there. So until then, be healthy, stay profitable. I hope you find your blue sky trade and keep coming back to barchart.com for new ideas.